What's going on, guys? It's your boy Tyler, bringing you fundamental analysis on a fundamental basis. Guys, it is the 6th of December 2025. The markets have really done well this year. We saw the Bitcoin go from 50,000 all the way to 100,000. So, basically, going to read from you guys an article from investing.com. You can also get this article by yourself. I'm going to read it and then I'm going to explain what's going on. S&P 500 near key breakout zone as markets bet on a Fed cut fueling a center rally. Fed cut expectations power the rise, but momentum slows as tech valuations look stretched. We've been talking about the overvaluation of the AI stocks. Michael Berry recently said, accused Nvidia of cooking their books. So people are quite concerned about valuations. Anyway, key support is at 6,791 and 6,812. Holds the trend. If it breaks below, shift could focus to 6,731 and then 6,590. 6,852 to 6,900 is the supply wall. Breach of that supply wall would take us to 6,953 and then the psychological level of 7,000. Global stocks advanced in the first half of Thursday's session, and the US futures pointed to a flat start for the S&P 500, following a run in which the index has risen in 7 of the past 8 sessions. But the slowing pace of the rally and existing concerns over a potential bubble in AI and tech names are among factors that have some traders wondering whether a Federal Reserve interest rate cuts next week will help drive so-called the Santa Claus rally into the year end. I believe it is going to happen. We're going to see the Santa rally happen. Why have stocks been rising? Expectations of Federal Reserve rate cuts have helped the markets claw back ground after November's wobble. November was a bad month, guys. We saw the S&P fall about 12%. We saw Bitcoin fall over 16%. So markets are only starting to recover now. November was bad. Let me continue with investors edging towards defensive names and broader sectors amid lingering concerns that tech valuations have run a bit too hot. Softening sentiment around the jobs market, coupled with growing expectations that President Trump will opt for a dovish-leaning Fed chair. I think the next Fed chair is going to be Kevin Hassett, guys, who is the National Economic Council, who's the director for the National Economic Council, and he's a good ally of Trump's. Trump will opt for a dovish-leaning Fed chair has nudged market prices towards prospects of up to 4 rate cuts next year. So basically they're telling us, guys, that 2026 we're going to have at least 4 rate cuts. Markets like rate cuts, and that seems to be offsetting concerns about the weakening jobs market and the potential for more job losses as firms continue to replace humans with AI. What risks are markets facing? Outside of the prospects of low interest rates and stable inflation, there are not many other supportive factors right now to keep the trend going. Recent concerns over the market's growing concentration in a small number of tech stocks and the risks of a bubble in the AI sector are still in the background. Meanwhile, Rising bonds in Japan have so far been brushed off, helped by solid demand for government debt and recent long-term bond auctions. What they're saying there is Japan was going to raise interest rates, but the bond market tells us something else. Usually, when Japan raises interest rates, people dump their US bonds and they buy Japanese bonds. So if that does happen, we could see the markets retrace and go into safer Japanese bonds. But if signs emerge that investors are rotating out of stocks and into bonds amid concerns over the reverse carry trade, then that could also negatively impact the US and global markets. Then there are recession risks hurting company profits, but so far none of these concerns have seemed to matter. S&P 500 technical analysis and trade ideas. Following last week's sharp recovery, the S&P 500 has made much headway so far this week. So even if it continues to hold a modestly bullish bias, largely because price has remained above last week's high, at the time of writing, the index still looked constructive, albeit without any real momentum behind the move. A handful of previously broken levels have been reclaimed, giving the appearance that the bulls are once again in control. With that said, the absence of any major bullish catalyst does raise questions over whether the market can generally extend from here. Sellers, for their part, have effectively lost control of recent price action. For sentiment to turn bearish again, we would need to see clear evidence of a reversal taking shape. For me, that would require a clean break below key support at 6,791 to 6,812. So if we break below 791, then you guys can expect a bear market. The blue shaped region on the chart, if that area were to give way, the index could quickly revisit 6,731 to 590, an intraday level. Coming into view thereafter, beneath that, the recent range lows at 6,525, 6,540 would re-emerge as the next downside target. As for resistance, the market continues to trade within the range of 6,852 and 6,900, a key supply zone in the area from which selling pressure first emerged back in mid-November before the subsequent recovery. The bears will need to defend this region firmly if they are to regain the upper hand. We're killing the bears, guys. Should the index instead break above 6,852 and 6,900, that would likely open the door to fresh all-time highs beyond the October peak at 6,953. And if we get that far, the natural question becomes, why stop there? A run towards 7,000, the next major psychological milestone for the S&P 500, would be perfectly plausible. I do agree with this article, guys. I do think that we're going to see 7,000 in Q4. So in summary, at the time of writing, the bullish bias technically remains intact, but the lack of momentum means risks are fairly balanced.